Hey, hi, this is Kirubakaran Rajendran. So, in this video, we are going to see what is a rule based swing trading approach. Like, if you are holding a stock, many people will be holding a stock, they do not know what is the right time to exit the stock. So, in this video, we will see what is a rule based approach to exit any of the stocks that you are holding in your portfolio. So basically, people when they buy a stock, they buy it based on a fundamental news, or no, they see if there is any specific news that is coming out in the media because of acquisitions or because of mergers of any kind of such news. People tend to buy a stock, and no, they do not know what is the right time to sell a stock. Like if it keeps on going in profits, for an example, if stocks like Adani, which has been in profits for a long period of time, where it moved from a few hundred rupees to few thousand rupees right now. So now people who are holding these stocks who are already in profit, they do not know what is the right time to exit from the stock, because only when you exit from the stock the profits are real. So whatever the profits, the open profits that you're seeing currently, those are just a notional profits. Tomorrow if a stock tanks, then no, if you're not able to book the profits at the right time, then you lose all the paper profits. So what is the right way to help you, or no, what is the right way to exit from these stocks at the right time? Because if you wait too much, then the stock would crack. But if you're trying to exit with a few rupees or few thousand rupees of profits, then the stock would keep going higher and higher. So what is the right way, or what is the right way to exit these stocks based on certain rule based techniques? So that is what I'm going to cover in this video. So many people are aware about 200-day moving average. So applying a 200-day moving average on any of a stock, and then whenever a particular stock goes below 200-day moving average, they call that as a bearish period. And when it trades above 200-day moving average, they call it as a bullish period. So as long as a stock is trading above 200-day moving average, they say, okay, it is good to hold this stock. But the moment it closes below 200-day moving average, people tend to think that the momentum has gone and it is wise to exit from the stock. But there is a problem with this approach. See, as long as the market is in trending mode, or as long as there is a momentum, then it helps to make higher profits by following a 200-day moving average strategy. But when a stock stuck in a range bound markets, when it doesn't move much, then those are the periods where following a 200-day moving average could give you a lot of whipsaws, lot of false signals. So there should be a other mechanism where you can follow the trend, ride the trend, and then finally exit the trend. So trend is your friend until it bends. So that is what they say. So we'll see a real-time example on how you can follow the trend following approach using certain rules and exit from a stock at the right time. So to start with, let us first see how 200-day moving average is widely used by most of the investors or traders. So the chart that you see right now is the chart of S Bank, where I would consider the 2018 period, where that is when the S Bank started moving down. So as you could see, after the stock has fallen below 200-day moving average on 21st of September 2018, the stock since then onwards started declining steadily. And people they call stock which trades above 200-day moving average or bullish, stocks that trades below 200-day moving average or bearish. And people who have exited, like since the stock is closed below 200-day moving average during 2018 September, they would have closed it. But again, it has moved up, where there was a slight pullback, and then further it declined and it declined and it declined, and eventually it is currently trading at around 15 rupees or 16 rupees. The problem with 200-day moving average is, see, as long as the market is trending, it is good. But for an example, consider this scenario where the stock has been stuck in a range. It neither moved up nor moved down. So in this case, whenever the stock is stuck in such range, it keeps oscillating between certain ranges. So there will be a lot of false signals. So there will be a lot of times where it closes below 200-day moving average, and again it closes above 200-day moving average. So it gives you a lot of whipsaws. So as a trader, you have to get in and get out very often, and frequently you tend to make losses because the stock is closed below 200-day moving average and again closed above 200-day moving average. So because of these frequent whipsaws, we tend to lose money. So how do we avoid these kind of scenarios? So there should be a way where you can exit from a stock without facing this much of whipsaws. So what should be the right way? So I'll show you that way. So what we have to do is, following a 200-day moving average is nothing but it just calculates the average of last 200 days. So obviously on a day-to-day basis, there will always be certain volatility, always there will be certain noise. So we need to move from daily based trading to monthly based trading. So what we have to do is change the time frame from 1 day to 1 month, and then now you apply the moving average indicator here. So instead of 200-day moving average, what I would do is I'll just let me clear all these drawings. Yeah, so what I'll do is I'll just apply the same indicator, but instead of 200-day moving average, I'm going to plot 10-month moving average. So whenever a stock closes below 10-month moving average, I'll exit it. And whenever stock goes above 10-month moving average, I can hold on to it. So what would happen is whenever there is no kind of a trend, like the stock moved from 50 rupees to 400 rupees here. But if you have used a 200-day moving average, you would have gotten and got out very frequently. But by moving into monthly time frame and applying a 10-month moving average, the overall noise has been removed. So by moving from daily time frame to monthly time frame, we are absolutely removing the noise, and then plotting the 10-month moving average into the chart will give you a clear cut signal, where whenever it trades above 10-month moving average, buy it. Whenever it goes below 10-month moving average, exit it. So this way we are able to hold on to the stock for a longer period of time, and also whenever it exits from a 10-month moving average, whenever it closes below 10-month moving average, you will be able to exit it. So when the stock closed by September 2018, when it closed around 250 rupees, we would have exited from it. And then since then onwards, then it continues to trade at the lower levels, where it continues to trade at 15 rupees or 16 rupees. So we would have exited it completely. So by moving from daily time frame to monthly time frame on a moving average levels, where instead of using a 200-day moving average on daily chart, use 10-month moving average on monthly chart, this would remove most of the noises and helps you to exit from a stock at the right time. Let's consider another example. So we have earlier seen instead of using 200-day moving average, it's better to use 10-month moving average. Is there any other indicator, or is there any other tool where we can exit at the right time? So let us consider an example of Adani Enterprises. So everybody knows that the stock has seen a phenomenal run, where from few hundred rupees 2 years back, currently it trades around 4,000 levels. So tomorrow, if Adani starts declining, what should be the right time to exit this stock? So I always say trend is your friend until it bends. So we just, instead of using it moving averages or any other indicators, I have a specific approach here called Donchain channel indicator. So once you go to indicators and select this specific indicator, you click on settings here and then change it to 10 and 10. Now that is nothing but what is the last high 10-month high price and 10-month low price, and click on done. So I have selected a monthly time frame here, and then I have selected 10-month high and 10-month low. It would automatically plot what is the last 10-month high price and what is the last 10-month low price. So the upper band, what you call it as 10-month high price, the lower band, what you call it as 10-month low. So what happened is, someone who enters at around 100 rupees or 200 rupees, and then if he has exited around 300 rupees, then you would have missed a bigger trend. Like the stock moved almost from 200 rupees to 4,000 rupees. That's huge returns. So instead of exiting at a fixed targets, let's follow this trend. So what happens is, whenever the stock closes below the lower levels, the lower Donchain channel, then you exit it. As long as it trades on the upper side, then it means that the trend is really strong. It can even go up to any extent. So in this case, people who have entered Adani, at this level, say for an example, let us see where it closed below the lower levels. See, in this price, almost 2015, it closed below the lower band. So once it closes below lower band, we are not going to enter into it. Only when it trades above the upper band, we are going to enter into it. So in this case, so let us zoom in and see. So around this 2017, it gave a buy signal. So which is around 2017 January, it closed above monthly average of 10-month high average levels. So now we would have entered into it. So as long as Adani doesn't close below the lower values, we'll continue to hold it. So a guy who bought around no 90 or 100 levels here in 2017 would have hold on to the position, and you'll see where it closes below the lower band, and it continues to trade and did not close below lower band, and it touched here but it don't now close below this band. So we'll continue to hold this position. So 2018 again, no, it did not close below, so it was continuously trading here. So only when it closes below we'll exit. So we haven't seen any instances where it closed. Even in 2020 during the corona crash period, it did not close below the lower band, so it continued to trade. So the stock which we bought at 90 rupees during last few years here, where when it closed above the upper level, we are continuing to holding the stock, and then we are trying to trial it, and the stock still goes up. Then what happened post 2020 July, the stock started moving up phenomenally, and we are not going to exit with any fixed targets. So our rule is to exit only when it closes below this lower band. So this, as long as the stock continues to move up, the lower band will also continues to move up. So currently, for an example, the stock now around 2021 during February or March, it was trading around 1000 levels, and if you see, the upper band is around 1000 and 200, and the lower band is just 140. But as long as the stock started moving up, the lower band also moved up. So it is nothing but whenever the stock trades or goes below the last 10-month low level, we'll exit it. So for an example, by 2022, currently we'll see. So by 2022, in the month of October, the 10-month low level is 1500 levels, and 10-month high level is 4000 levels, and the average level is 2700 levels. So these are the three channels. So for us, only when the stock goes below this level, we'll exit it. Unless and until it doesn't go below, we'll try to ride the trend. So currently, we have bought at 99 rupees at the beginning, and currently it trades at 4000 levels. So as long as it doesn't close below this level of lower level, we'll continue to hold this position. So this is the right way to exit a stock. So instead of relying on news or instead of relying on any of the fundamental parameters, we have two different approaches to exit from a stock. So as I mentioned earlier during the beginning of the video, instead of using 200-day moving average on a daily chart, start using 10-month moving average on a monthly chart, so that it reduces all the noise. So that is one exit parameter. So whenever a stock goes below 10-month moving average, you can simply exit from that. And whenever it trades above 10-month moving average, you can just get into it, buy it, and exit it when it closes below 10-month moving average. And second thing is, whenever a stock, for an example, stocks like Adani or be it any kind of stocks which has moved phenomenally, which has gone into a higher momentum phase. So another approach to exit from a stock or to enter into a stock is downtrend channel, where it is nothing but it tracks what is the last few days high or few months high price and what is the last few months low price. So again, in downtrend channel, instead of focusing on the daily time frame, we are moving into a monthly time frame and then applying last 10-month high price and applying last 10-month low price. So this would give you a specific channel like structure, where as long as the market trades above this 10-month high levels, we'll continue to hold the stock. And whenever we never know when a stock trend would reverse, so that is why we this specific down channel indicator keeps on trailing the levels. So the moment it closes below the lower 10-month downtrend channel level, then we'll exit from the stock. So these are the two different approaches that you can use to exit from a stock using certain these rule-based techniques. So if you guys have any doubts, you can post it in the comment section. And also, if you wanted me to address or talk about any other topics, you can just comment mention that in the comment section. I'll try to address those topics in the comment section. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.